Hello and a very warm welcome to Policy Watch, our weekly program that keeps you abreast of all the key economic developments in the week just ended. This week we will discuss major changes that we've seen on three fronts: inflation, the current account deficit and the stock market. I'm Mythili, Bhusnurmath, your anchor for the show, and joining me in this discussion is Jagannadham Thunuguntla, Equity Head, SMC Capital. Welcome to the show, Jagannadham. Let's start with the inflation story first. For the first time in many months, the inflation data gave us something to cheer about. Both the consumer price index that was released last Monday and the wholesale price index that was released a day later show that inflation might finally be trending down.
Inflation based on the consumer price index, which is close to the experience of ordinary citizens venturing out of their homes, or maybe even without venturing out of our homes thanks to internet and e-commerce, came in at 9.39% for April 2013. This is not only a full percentage point lower than what we saw in March 2013 when it was 10.39%, but is also a 13-month low. The WPI data, which came in a day later, reinforced the perception that maybe we are winning the fight against inflation, with the number for April at 4.89%, a 41-month low. The last time we saw WPI inflation below 5% was in November 2009.
We have been saying that there is clear evidence of softening of inflation, but bottom line is that the original picture that the inflation situation is improving is very much there, and frankly, if it comes to around 5%, I mean, then basically it is what we normally regard as an acceptable level.
In a bid to protect ordinary savers who have had to live with negative returns on their savings for the past 2 years, RBI announced that it will come out with its first tranche of inflation index bonds in June. This decision, which is in line with the promise made in the budget, is expected to induce people to move away from physical savings to financial savings. While the first tranche would have a small portion reserved for retail investors, the second tranche would be exclusively for retail investors. The inflation index bonds would have a fixed real coupon rate and a nominal principal value that is adjusted to inflation. Periodic coupon payments would be made on the adjusted principal. This is an improvement over the bonds issued by RBI in the late 1990s.
Well, that was the report, and we've heard what the Deputy Chairman of the Planning Commission, Montek Singh Ahluwalia, had to say. But let's hear what Jagan has to say. What do you think, Jagan? Finally, we've seen the WPI and the Consumer Price Index both come down. So do you think this is a happy thing or a trend? Is it part of a trend, or is it just a flash in the pan?
Inflation came down finally, and that definitely base effect has helped it, because it's almost a fight of 3-4 years. 2008 stimulus has led to this inflation. I think the fight of inflation by RBI went too long, even for anyone's expectation, and finally it came down. I just feel it's because of base effect. I don't think there is any real comfort as such for a middle class or a lower middle class person. But having said that, at least from the headline point of view, at least from the numeric point of view, it feels good, and then probably it gives a required legroom for the RBI to do something.
No, because for a long time we've been saying that, okay, the wholesale price index has come down, but how is the consumer supposed to benefit? Yeah. Because the consumer price index hasn't come down. Now we've finally seen the consumer price index also come down to single digit. So that surely should be a sign of some cheer, and maybe the RBI, especially the hope is that if the RBI finds both the indices coming down, then there may be some policy space, because if you remember, the governor had said that we have no policy space. Now with both the indices coming down, do you think he'll find policy space and cut interest rates?
Absolutely, yes, because if you see the investment cycle in India completely got broken down, because in the last 2 years, I can't think of even single mega project that's being launched by any Indian corporate. They were just preserving their cash, and they were because they were going very slow, conservative. But now with this RBI, if it gets that legroom, RBI realizes the fact that growth has to come back, because India has a huge population base. Employment opportunities are needed. Otherwise, there will be a lot of restlessness. High inflation and low employment opportunities more dangerous than inflation alone. So I think the employment opportunities have to be recreated. meaning thereby the RBI will be aggressive this time in the rate cuts. I think finally the waiting moment has finally is here.
Except for the fact that because, we've had a series of rate cuts and, in fact, inflation has been so high, the ordinary saver, he's been getting negative rates of return. So if the RBI were to cut rates further, even though inflation is still not, entirely under check, do you think that will affect domestic savings? As it is, domestic savings have been coming down, and that has been a cause of big worry because ultimately investment has to be funded from domestic savings. So how does the RBI balance these two, the saver as well as the borrower?
Actually, inflation is an anchor point, and moreover, interest rate is a gravity around which entire asset class and entire money flow happens across the markets. For example, if interest rates come down, it helps in many ways, not just in terms of not just in terms of creating energy, creating new projects, and creating everything, because that will make the average person think about putting his money into more risky asset classes.
Okay.
Because as of now, because he is getting 8.5% comfortably in the bank.
But that's still negative. Inflation was 10%, so 8.5% doesn't help him.
Absolutely. But now with this inflation at 5%, and if interest rate comes down, it will make a lot of changes, because now an average Indian has to think about investing somewhere else, because if the bank deposit rates come down to 7%, 6.5%, 6%, 5%, which was the case 3-4 years back, now he has to put his money into the risky assets like, say, equity or in something else. So the whole dynamics will change. The moment if equity inflows increase, what will happen is that the IPOs will increase, meaning there will be new projects will increase, the entrepreneurship will get triggered. So there will be a lot of internal systemic changes will happen.
So do you think this inflation index bonds that the finance minister had promised in this budget, RBI has finally come out with a circular on that. So do you think that will make a difference? Because after all, if the person, the saver, is ensured that he's going to get some positive real return, then maybe he'll put his money into financial instruments rather than gold, real estate, etc. Because as we've seen in the case of gold, it has implications not only for financial savings, but also for our trade deficit, current account deficit. So how do you look at these new inflation index bonds?
True, but irony is that the bonds announcement came exactly at the time when inflation came down. So when the whole disease came down, the inventor has found a medicine. So I think that's the whole funny side of it, because ideally it would have been fantastic had these bonds were issued 2 years back, because when the inflation was the problem, when inflation was around 10, 11, 12%, people would have made 13, 14% because it will be inflation plus something.
Yes.
But now as the inflation is back to 5% or 6%, and then you add that 1% to it, technically people are making 7%, which is lower than the bank deposit. So meaning thereby, I think probably inflation index bonds relevance may not be enjoyed by the people at this moment when inflation is sort of downward trending. But having said that, considering Indian middle class population base, I think those bonds are very much needed. Globally, they are very popular, but India, we are a late entrant into those innovative structures.
No, because in 1997, the RBI had come out with very similar bonds, but that time only the principal was indexed to inflation, not the interest. Whereas now both interest as well as principal are going to be indexed to inflation. So actually, as far as you had an issue on timing, but perhaps there's an argument that, this is the time, because for government, it becomes easier for you to issue it when inflation is trending down rather than up. And it helps to anchor inflation expectations. After all, this is not a one-shot thing. The RBI said that they're going to come out regularly every month. The first tranche starts in June, on the 4th of June. And of course, surprisingly, they have said that only 25% is going to be given to retail investors. But the subsequent tranches, the entire portion will be for retail investors. So given all these assurances, do you think the Indian middle class and the Indian saver can be educated to look not at nominal rates, but to look at real rates?
Absolutely, no question about that. I think these bonds' relevance is more in countries like India than countries like United States, because there it's a different ball game because there's an institutional approach to the whole equation. But whereas here, considering the retailers and considering that middle class is very high, I think definitely needed. Moreover, if that is linked with the demat account concept, what will happen is that we can create a huge demat account population also, because that will create opportunity to open up more instruments and more, because people may fear to invest in equity, but inflation index bonds, because people may illegally open the account, meaning thereby at least they can be brought into the whole scheme of things. New instruments probably can be sold later on.
Absolutely, and particularly I think the attraction of gold in India, of course, there's a lot of attraction partly for societal reasons, various other reasons, but the main reason why there's been a sharp increase in gold imports has frankly been because of uncertainty and people feeling insecure because of very high inflation. Now we have these inflation index index bonds, clearly that aspect of this worry, this fear about the future will be taken care of.
Absolutely, I think very innovative. Only thing is just that the whole fun of it will be fully enjoyed when maybe the inflation comes back again. But in this downward trending, it will be good for government. But from the average person point of view, I think he may feel that eventually he is getting the more or less the same return what he is otherwise getting on the bank deposit rates. But having said that, structurally speaking, I think it's very much needed instrument in Indian country.
Okay, that's a wonderful perspective with Jagannadham. But I think at this point we'll just have to take a short break. But please do stay with us. We'll be very much back with you. Please stay with us for a very short break. The next major development that we had during the week was once again linked to data release, but this time from the Commerce Ministry, that showed that the country's merchandise deficit for April had widened alarmingly. In fact, the trade data for April almost completely offset whatever cheer we'd seen on the inflation front. But let's look at what the numbers are to say.
Exports continued to grow, albeit at a much slower rate of less than 2% compared to 7% in March. Imports grew much faster by almost 11% compared with the same period last year. As a result, the trade deficit, which is the gap between our exports and imports or between our dollar earnings and payments, widened to $17.8 billion for the month, much higher than $10.3 billion recorded in March 2013. The trade data does not bode well for the current account deficit, which is trade deficit adjusted for our net earnings on invisibles like services. Markets promptly tanked, with the Sensex falling by 430 points, even though the inflation data released on the same day was encouraging.
Well, we've heard the trade numbers and they certainly aren't very cheerful. But let's see what Jagan's perspective on this. Jagan, how do you look at the trade deficit numbers? Are they really as alarming as they seem?
As you rightly said, the whatever cheer that brought by inflation suddenly got cooled off by trade numbers. But we have to appreciate that the slowdown is very much a reality. I think that was clearly visible. I think things are definitely on the slower side, not only in India, even globally.
But actually, exports had grown for the fourth consecutive month. Exports had gone up. So why did the markets react like that?
Yeah, I mean, the fact is that the net figure is a matter of concern, and moreover, that immediately showed up on the rupee, because at the same point when the FIs were putting in money, generally speaking, the rupee should have been more towards 53 or maybe 52 even. Suddenly it is to 55 and even threatening the level of 55 and maybe even going below that. So I think that is not missed by the markets. I think definitely it's a matter of concern. And moreover, what we have to appreciate that the level that market is seeing in terms of rupee, that 55, is already taking into account FI. Just imagine, spare a thought, if FI inflows were not coming into the equities, we would have been witnessing.
So you think the markets were reacting to that?
Yeah, and it would have been closer to the all-time low of 56, 57 levels.
Okay.
So I think definitely it is a matter of concern. But hopefully, if the things pick up and let's say if inflation comes down, if RBI gets the leg room, and then if the policy rates come down, and then if it leads to again animal spirits in the Indian corporate world, as put by our Prime Minister, probably can re-stimulate, and the whole scheme of things probably will pick up. But at in the short-term point of view, definitely market is definitely has reacted on the currency front.
But if you look at the data, exports grew, of course, little less than 2%, but imports actually shot up quite alarmingly by almost 11%, as a result of which the trade deficit was much wider than it was in the previous month. And if you look at imports, the breakup of imports, well, he's always known the three major items of imports are coal, oil, actually in that different order, oil, then gold and coal. And particularly coal, the government has tried very hard to try and increase coal, domestic production of coal. On gold, they've tried even harder. They've tried all kinds of duty hikes. The RBI has tried to tighten gold loans. But despite that, gold imports actually grew by 138%. Even though gold prices actually had come down, Europe seems to be, not quite entirely, but the US seems to be recovering. So what explains this dramatic, fascination and increase for gold?
That gold is a very tricky part as far as India is concerned, because generally speaking, whenever there is a dip, generally globally speaking, as a financial instrument point of view, there will be a little bit of panic. I mean, let's not touch that financial asset.
Yeah, you want to sell.
Yeah, you want to sell, you don't buy. Whereas in India, every dip is considered as a buying opportunity. There is a perennial demand, and gold is considered as God's currency. So I think as if gold will never come down kind of feeling. I think there is a huge surge. I think I was hearing that in the gold shops there is a queue, and then this time Akshaya Tritiya, people have aggressively bought. So it seems that the gold dip, when it happened, while everybody thought that probably it will help the Indian deficit numbers, but actually it is other way around. Actually,
so that means Indians buy when the price price falls, they buy when the price rises, they just keep buying endlessly.
Absolutely.
Okay. So then what can one do if your gold imports cannot be curtailed? Your oil imports, we import almost 70-75% of our oil requirements. So oil also we can't do anything about. And coal, given the kind of problems we're seeing on the coal front and all the scandal, the corruption that is associated with it, you can't do anything on coal either. So your non-gold, non-oil, non-coal imports are very low, showing that economic activity is very low. How can we kind of improve those imports and reduce these? Is there any way out at all?
On the oil front, crude oil prices have cooled off to some extent. Probably that will give a little bit of relief.
Okay.
And on the coal front, most of the problems in India, coal productions are man-made.
Absolutely.
Whereas in case of oil, it's natural resource. Whereas in case of coal, it's man-made. If the larger picture is kept in view, and if things can be resolved, of course, easier said than done. I think that equation can also be sort of resolved. I think while Supreme Court they have every right to judicial angle, but at the same time we should not put the country at risk and country's interest at risk in the whole scheme of things, just for the sake of putting one or two companies, faltering companies into behind the bars or something. I think we should not mess up the whole equation. That is where one equation probably a little bit of more common sense needs to be prevailed, of course, which is not common generally. So I think from the gold point of view, as we discussed, and these three, I think most of gold is again a man-made problem in India. That's psychological problem. So
is it psychological entirely? Because after all, this attraction for gold is always there. It's been part of the Indian psyche, but it's increased dramatically only once inflation took off like this. Earlier also people like to have gold for whatever reasons, but this fascination, the sudden fascination, the newfound fascination is only post the hike in inflation that we've seen. So given that inflation has coming down but hasn't really come down to the RBI's comfort level of 5%, can we really expect to see the gold demand coming down?
Actually, what happened is the gold was having almost a dream rally of 12 years, because generally when the 12-year rally, people have a right to assume that it will never come down. If you invest by the end of next year, you will be richer. So at least you will feel richer. I think more than inflation point, it's just that once in a life bull run that is happening in the gold is attracting more and more people. Now the first dip people have bought. Now question is, if there is a second or third dip, and people will start fearing that it may be a continuing bear market in gold, probably then there may be a little shying away from this asset, because we've seen in the equity 2004 to 2007 at every dip people bought. But 2007, the end of the 2007, once there is a complete collapse, so people have shied away. So need to be checked in the next 6 months or 1 year. Probably we'll find out whether this whatever dip in gold, whether temporary routine correction or it's a sign of the long-term bear market.
Well, the World Gold Council is very, very bullish on India.
Yeah.
They're quite convinced that Indians will keep buying more and more.
Absolutely.
So last year we had something like 1,000 tons, and this year they say we'll again be almost back there. So clearly, as far as the World Gold Council is concerned, India is the market to be in. So I'm not very sure that we will really see that gold demand dip. What do you think of RBI's measures of consignment? They've made it very difficult for people to buy on consignment. Will that help curtail?
No, these are only peripheral issues. I think it's psychological. I think you can't change Indians, you can't change Indian women, especially. So
the only thing you can really do is increase our exports. So I think we'll take a break over here. But please do stay with us. We still have one more story, and that too on the most exciting topic of it all, markets. So please stay with us. We'll be back soon. Welcome back after the break. The last major story for this week is on the stock markets. How is an ordinary investor supposed to have any confidence in a market that dips 430 points one day and then just jumps up 491 points the next? You could argue that markets were responding to inflation data that had come in, but the previous day they had just disregarded the positive inflation data. So can we say that markets are completely irrational? Let's hear more on this from Jagan. Jagan, how do you read the Indian markets?
Yeah, I think global liquidity is the real theme. I think nothing more than that. I somehow don't want to call it as a bull market. If you recall, generally a traditional bull market gets featured with a lot of IPOs, a lot of events, and a lot of issuance of paper, new account opening, new people coming in, but nothing is happening. So people are as skeptical as ever, and then no new IPO. When was the last IPO we ever seen? Coal India, maybe the 2.5 years back, when was maybe a meaningful IPO? So what is meaning there by global liquidity coming? Japanese Bank of Japan is pumping in fresh bouts of money because even that country was under stress for the last 20 years. I think that is leading to US market all-time high, Germany market all-time high, Indian market close to all-time high. So what it reflects is not an Indian theme.
But this global liquidity has been there now for about 3 years. So what changed so dramatically?
In November 2012, the new Japanese Prime Minister
Only Japanese, yes. Yeah. The US has been reflating.
True.
So has Europe. Yeah. And Europe is still in a recession. So will Japan alone make that difference?
Actually, the US and Europe rally has taken the market all the way from 8,000 to 17,000. When that fresh wave of energy is needed, that Japanese just came in at the right moment. But we have to remember that this is not an Indian theme. It is international theme. Most of the global markets are at all-time high. And one more thing is that the markets have completely decoupled to the Indian political developments. For example, one more scam announced, market 200 points up. One more scam announced, one more resignation by minister, markets are 400 points. So market is just cheering. Markets are completely cheering about. I think maybe they are feeling relieved.
No, and if you look at the data, almost every day, foreign institutional investors, they go on pumping in money and Indians keep pulling out money. So what is this contradiction? Is it that we are very despondent and we're looking at markets very pessimistically and foreign investors are much more optimistic about it? How do you explain this disconnect?
The staying power is different. For example, the ability to stay, the worth is altogether different. For example, a global player probably can stay longer. Moreover, most of the people why Indian money is leaving is all this money got stuck 6 years back. In 2007 rally, when the market was at 6,000, all this money got stuck. People are saying at least my money is coming back.
So cut loss.
Cut loss. I mean, let's get out of it. I mean, it's too much of it. So the way a foreigner will look at is altogether different. The way Indian, considering that his risk appetite is altogether different.
But doesn't that increase the country's vulnerability to a great deal? Because that means we're dependent for our huge current account deficit. We're depending entirely on these foreign inflows, which are easy come, easy go. Today the foreigner is in love with India, tomorrow he's not. So isn't that a very dangerous kind of situation? How vulnerable are we?
But we are highly vulnerable and susceptible, no question about that. And moreover, that's a hard reality because as they say that we may love FIS, we may hate FIS, but we need their money. So we have to appear we are we are in love with them. So that's the hard reality because no entire mutual fund industry AUM put together, entire Indian retail investor stake put together can't match the FIS muzzle. So I think moreover, India only barely 1 crore active demat accounts in India. So that is not sufficient to match the muzzle of FIS. If their money is not coming, all of us know that where the Indian markets were, let's say 10-15 years back. SAIL was trading at 4 rupees and Tata Motors was available at 8 rupees. So do we need a situation where Tata Motors kind of company trading at 8 rupees with only Indian investors, or a rightly valued Tata Motors, enabling them to raise fresh money and enabling a new factory, and then in the process maybe taking a little bit of risk with FIS? Because one thing is sure that everything comes as a package. Risk and reward comes as a package. You never have a situation of 100% risk or 100% reward. It's all about balancing between them. So whatever risk that is involved with FIS, speedy money, I think there are rewards as well.
No, but as far as stock market investors are concerned, whether you're talking about foreign investors or domestic investors, does it not have to have something to do with the fundamentals? As you yourself said, our economic fundamentals have not really improved significantly. The only change that we've really seen is on inflation data. And that's too early in the day also. Slight increase in IIP, improvement in performance. But on the political front, there's much greater uncertainty. So what is it? Are the markets completely disconnected? You always hear that markets are, looking at the future, but they cannot be divorced from fundamentals. How long can this continue? What would you advise people?
One quick statistic is that any typical Indian day has about 2 lakh crores of trading volume. Out of that 2 lakh crores, 1,90,000 crores is F&O. 10,000 crores is cash market. So all these fundamentals, Excel sheets, DCFs, valuations, all that belong to that small section of 10,000 crores, which is 5% of Indian trading volume. 95% of Indian game belongs to F&O, which hardly, valuation, DCF hardly matters. It's just a leveraged money, want to make a quick buck. It's a speculative money, come and go. So there is a huge bit of disconnect. It's only 5% is the real valuation driven.
I think at this particular point, we'll have to stop. I think we'll come to the three takeaways that we had on 3 major developments that we've seen. On inflation, yes, I think Jagannadham has agreed with me that we are fairly optimistic, but it's a little early in the day to really say that we won the game against inflation. On trade data, he's a little bit more positive, maybe because he feels that yes, that things are looking up in the world, and if we can manage on things on the coal front, oil prices coming down, gold also with inflation coming down, maybe we'll perhaps do a little bit better. So there's not much to worry about on that front. As far as markets is concerned, he's entirely in agreement with me when he says that, look, markets have really nothing to do with the fundamentals of the Indian economy, very little to do with the fundamentals of the political situation, entirely liquidity driven. And on that note, I think I'll have to thank you, Jagan. Thank you very much for joining us. I do hope you enjoyed watching the program as much as we enjoyed putting it together for you. Thank you so much.